Hello and welcome to the big story here on the BDTV Breakfast Show. This is where we discuss issues shaping our nation and our economy at large. My name is Elizabeth Musa. Today we'll be having a talk show on personal finance, focusing on investment, sharing knowledge on where to invest, how to invest, associated risks, and how an investor can avoid pitfalls in investment. Our guest this morning is Mr. Tajudeen Ibrahim, is the Director of Research and Strategy at Chapel Hill, Denham. And to join him in this discourse this morning will be our in-house analyst here at Business Day, Mr. Ojabelo. Welcome to the show, gentlemen.
You're welcome, Elizabeth.
Let me start by asking you, Mr. Tajudeen, firstly, before we just go straight into the conversation. What do you think, when you hear a struggling economy, what does it mean to you, and would you describe Nigeria as a struggling economy?
I think it is befitting for Nigeria to be described as a struggling economy. Number one, when you consider consumers' purchasing power, when your purchasing power has dropped significantly, either on the back of, or let me say largely speaking, on the back of government policies, because we embarked on reforms. You have your spending power declining or reducing significantly, and that does not apply to just one or two individuals or just a set of people. It applies to a very large percentage of the population. So from that standpoint, one can say Nigeria is a struggling economy. To even make it worse, we have a situation where the prices of goods and services have gone up significantly in the past 24 months. So that makes it to be like a situation where your lower spending power is also facing higher prices in the market. So overall, the economy is struggling from that standpoint. The third element is around the exchange rate. We have been struggling as an economy to stabilize our exchange rate. And on the back of that, we had to allow about 2 to 3 episodes of devaluation within the past 24 months. So that is another sign that this economy is struggling. And the three indicators cannot be neglected from an analysis standpoint. Yeah.
Thank you, Mr. Tajudeen. Now, considering the three major indicators you've demystified, how do you think investors will react considering this point?
I think investors, will react in a way that, will still make it profitable for them in terms of investment, because when you have dislocations in an economy, such dislocations present opportunities for investors to take advantage of. When you look at the devaluation that we encountered, what devaluation implied is that for dollar investors, it is largely positive for them. For every dollar invested, you stand the chances of gaining more naira, because our currency is becoming weaker, or it's been devalued against the US dollar. So from that standpoint, an investor can position accordingly. Know that it is an economic dislocation, but the reality is that it presents an investment opportunities for those that identify such an opportunity and can take advantage of it. That is number one. When you take a look at inflation, what you find in inflation environment is that when inflation rises, what eventually happens is that the Monetary Policy Authority would have to respond accordingly by raising interest rates. Yeah. So a savvy investor will position himself or herself to take advantage of rising interest rates, and will climb that ladder along with the economy, investing with rising yield on investment. So that is another way that investors are able to play the dislocation in the economy.
Thank you, Mr. Tajudeen. You made mention of market dislocation, and as a result of that, some hedgers capitalize in terms of dollar investment. Are you not seeing that as a rent seeking affecting the economy?
So it is not so much of a rent seeking,
Okay.
because what it means is that you, naturally speaking, as an investor, will be expected to diversify your investment.
Okay.
So diversification is just not in asset classes alone, speaking to equities, speaking to fixed income and alternatives. Diversification also comes to the fore when you look at currency.
Okay.
So you have some of your investment in local currency and you have some of your investment in foreign currency. So whichever goes either way, you are good. You are protected. If the naira strengthens against the US dollars, your naira holding investment, will be, will give you that expected return and reward. When the US dollar goes against the naira, your dollar investment will also reward you accordingly. I think we should just see it as diversification instead of seeing that rent seeking.
Okay, meaning that investors are after maximization of their wealth and also looking for a way to avert risk.
Absolutely, it is a combination of you trying to generate strong returns and also try to reduce your risk exposure. Right. A good mix of risk and return is what makes a very good investment.
Okay. Allow me to come in here. We've established three things. You said there are three factors that, of course.
There are several, but those three are on the front line.
On the front line for you, defining a struggling economy. So in your opinion, with all of these things that you have noted, what then would you say would be the best form of investment for investors right now in a struggling economy, like people that want to come to invest in Nigeria from out of the country, and maybe even Nigerians themselves?
I think if you are looking at the current environment, no doubt those that started investing in money market or fixed income instrument when interest rate was rising, no doubt a lot of them have made sizable money or return on investment, no doubt. But interest rate as we speak is slowing down, currently falling. Also those that invested in dollar denominated asset when we had our currency at around 600, even 1,000 level, as we speak, they seem to have maximized their gain, because the currency as we speak is broadly more stable compared to previously. So the question would then be, what do we still have on the table? I think we have equities on the table, because there are some equities that are going to, number one, outperform the broad market. Number two, outperform inflation. When your investments cannot outperform inflation, then you are generating negative real return on investment. So equities are the asset class I believe investors can come into as we speak, and they will still be boasting of sizable return on investment over the next 12 months.
Thank you very much. When you look at macroeconomic indicators, over the years, Nigeria has experienced negative real interest rate. Why? Because the MPR rate, the inflation rate is always higher than the MPR rate. But based on the current rebasing, which made the inflation rate to fall to 24.48 from 34.8, why the monetary policy still hold the MPR rate to be 27.5. Now, when we look at the difference, there is a positive real interest rate. So as an investor, what kind of financial instruments do you advise them to invest on, considering the real positive real interest rate?
So my sense is that investors can consider what I call corporate instruments. And when I say corporate instruments, it could be the bonds issued by corporates, it could be the commercial papers issued by corporates. When you buy into that, that kind of instrument, what you are doing for yourself is to generate a return that is slightly higher than what you would generate if you were investing in government instruments. So when interest rate is falling, you will still find a case where corporate bonds, corporate commercial papers will still give you more returns compared to what you will get with the other with the government.
Exactly.
That is on one side. But when interest rate is falling, the most compelling asset class to consider are equities. For the following reasons. Number one, you would have a situation where the companies you are invested in or you are investing in are having lower cost of debt. When there's lower cost of debt, it implies that their earnings are going to be a lot more robust compared to if there was no lower cost of debt. Number two is that from a valuation standpoint, the weighted average cost of capital is going to be much lower in a low interest rate environment. And that will mean that the valuation of the company you are investing in will be much higher, and it will attract more investors to come and meet you that you are already established as an investor in the company. So it takes you to quickly identify all of those investments before more investors come to buy into that investment.
Very clear.
I like how this conversation is, looking really, we're making it very technical, but I also like us to address it from the standpoint of someone who is just out there watching this show today and is thinking, okay, I'm hearing equities, I'm hearing macroeconomic investment and all of that. I also just want to know, I want to have a very general sense of this topic. So the other day we had one of our front page stories that said that, right now is not a good time for real estate investors, that many of them are crying, so to speak, about the investment they've made, especially those of them that have office spaces, the ones who are, building office spaces. So I want you to please speak to that. Do you think that this is a good time, or what would you say about that story? Do you think this is a good time for real estate investment?
I think real estate investment is something that almost no investor will go wrong, investing in or taking part in that sector in terms of investment. Take a look at real estate. What you find is they are cost-based to start with. They have two sets of sources. The first source is local currency cost. The second one is foreign currency source, and that foreign currency source is dependent on the movement in the exchange rate, and that is what in most cases make the prices of properties to go higher. So when you invest in real estate, what you are doing for yourself is that you are preserving value for the future. Because an asset that you purchased last year, a property that is purchased last year for 75 million, and I'm giving you an example of an asset that I purchased last year for 75 million, exactly March last year.
Right.
As we speak, the value has more than doubled.
Wow.
You get? And it is more than doubled because the current investors in this space are capturing what we call replacement costs. If it cost me 45 million naira last year to erect a property, and I sold for let's say 55 million, this year it is costing me 75 million, and I can sell for 100 million naira or thereabouts. So if I had that similar asset that is just constructing this year, if I had it since last year, I will also be marking to market. Meanwhile, I got mine for 75 million naira, and I'll be marking to market on the current prices in the market. And the prices in the market is moving largely because of the dislocation in the economy, because of exchange rate movement. Secondly, because of demand. Demand for real estate is strong, no doubt, but it depends on which aspect of it you are looking at. If you are looking at residential properties, the demand is on the high side. Rent, for instance, is something that is very hot in Lagos as we speak, because the supply is just not adequate. So you almost would not go wrong if you are investing in real estate. You only need the required waiting period for you to reap the benefits of your investment.
And on your account, what risky investment will you say right now no one should be looking at? This is risky.
So I think maybe an investment that I may consider risky is you betting against the naira. If you are betting against the naira this year, over the next couple of months, I think it is a risky thing to do. So because all of the fundamentals in place suggests that one should not be betting against the naira. If you had betted against the naira 2 years ago, you'll have done the right thing. If you had done the same thing last year, you'll have been in good hands. But this year, I think investors should be careful betting against the naira.
Interesting.
Thank you very much, Mr. Tajudeen, once again. But you made a point talking about the cost of debt. I want to take you back to the capital structure, talking about the equities. Considering the current situation, say, okay, investment on equity might be better. So now, when we talk about capital structure, then we are talking about the debt structure and the equity. Now, considering presently, I think in the last 7 days, due to the FAC allocation, there is instability now in Naira. Don't you see investment on equity as a challenge?
I think what we are seeing on the naira in terms of the pullback in the gain that we have seen so far this year is going to be short-lived. Short-lived because even the impact of FAC allocation is always short-lived. FAC allocation in the market will lift the level of liquidity in the system, but that liquidity dries up very quickly, not lasting for more than like a couple of days, and then the market is back.
Restore back to
back to normal to normal levels. So I think it is going to be short-lived, and I would not recommend to investors to look at what is going to be short-lived. I think anybody investing should have not less than like 12 months period in terms of your time horizon on your investments. No doubt you can take profit if you find any opportunity within the 12 months period, but for you to be expecting something spectacular in terms of return in like 1 month, 2 months, I think to my mind it is too speculative. But when you have like a 12-month horizon, all of the impact of FAC allocation in the system will fizzle out if you have a longer term horizon in terms of your investments.
That's great. That's great. Now, one more thing. When we talk about the current situation where the MPR 27.5 is greater than the inflation rate, so we have like 3 point something, which is the positive real interest rate. So what do you advise people who are low income earners to do? Should they increase to save because of the interest they are going to earn from it? Or what can you say about that?
So I think the way to view that thing is to put it in perspective. And putting it in perspective means that you are looking at the monetary policy rate at 27.5%. But your question is anyone getting the monetary policy rate as their yield on investment on any of the instruments in the market, either FGM bond or 1 year OMO or 1 year treasury bill?
TBS.
The answer is no. Absolutely nobody. Because inflation trend, because of that rebasing, has changed the entire narrative and the way the market is looking at commercial paper, treasury bills, and even OMO. So instead of us to have real positive yield on commercial paper, on treasury bills, on bonds, we are having negative real yield. So meanwhile, the 27.5% is presenting a positive real policy rate. So there is that dislocation, and I think the dislocation is there because there is a time lag in terms of when the monetary policy authority is ready to take an action. And because they need to watch the newly rebased CPI over like a 4 to 5 month period before they can begin to address or cut monetary policy rates. But the market doesn't work that way. The market does not wait. Once the market sees a new number, it begins to react to it immediately. That is the reason that the moment we saw 24.8% inflation rate, 24.48% inflation rate, the yield on all of those money market instruments just began to drop.
Nosedive.
And they nosedive to the extent that they now resulted in negative real yield. So which means that monetary policy rate at 27.5% is just waiting to go and moderate to where market rate is. And I call it one thing in my report that I published about 2 weeks ago. I call it a transmission mechanism from the market to the economy. Because it has a meaning. The meaning is that for treasury bill, it is now costing the government much lower to borrow money from the markets. For the bonds, it is currently costing the government much lower to borrow long-term money from the market. And when that is the case, it will feed into the economy one way or the other, because the cost of borrowing for the government is now falling. So what they could have used to service debt previously can be set aside for some other purposes in the economy. So that is what we are seeing now. We are yet to see the economy into market, but we are seeing market into economy.
Thank you very much.
Right.
I still want to go back to low-income earners. You know, we were taught then in economics that Y is equals to consumption plus savings.
Correct.
Now, good. Now, in this case, people now say that, okay, based on what the figure is showing, those people that did not have the knowledge of the economy, the market, that now most people are saying that when you save more, when you save now, you will tend to earn more interest on your savings. So to low-income earners, let's say someone who have like 100,000, 200,000, what do you advise them to do? What kind of investment can they do?
Let me put this out there. If you are a low-income earner in Nigeria, my advice is that, and you want to invest,
grow your wealth. Yeah.
You want to grow your wealth. You want to invest. My advice is that you invest in mutual funds.
Mutual funds.
And the kind of mutual funds you will invest in is, you can consider money market mutual funds if you are risk averse, because all of those mutual funds that are money market based, you find that they give you a more compelling return on your investment compared to you putting your money in your savings account. Put your money in your savings account, the maximum you get is 30% of the monetary policy rate, and that is not more than like maybe around 6% or thereabout, if I'm not mistaken. But if you put your money in, let us say for example, you put your money in Chapel Hill then Arm Money Market Fund, you will get about 21% annual return, because that is what that mutual fund is delivering. Mutual funds naturally brings together wealth from many individuals. And a pool of funds becomes so big that it has a larger negotiating power to go and negotiate for higher interest rates, to go and negotiate for lower costs in the market. That is the benefit. So if you are a low-income earner, consider mutual funds. If you are risk averse, the mutual funds to focus on are money market instruments. If you are a risk taker, the mutual funds to look at are equities.
Thank you very much. Now let us demystify it the more to those low-income earners who struggled with some big grammars. Can you explain to our audience what mutual fund is all about?
So mutual funds,
in a layman terms.
Yeah, in a layman, mutual funds, I think I can describe it as follows. We have a situation where you have people that are a lot experienced in managing money. Those are the ones that we call investment managers. You also have a situation that investment manager has what we call license, such as the licenses issued by the Securities and Exchange Commission. And now they are allowed, because they have the license, to collect money from individuals and put in a pool of fund and invest in several asset classes. Let me give you an example. We have Mr. ABC.
Okay.
Each of them has 5,000 naira to invest.
Okay.
They are low-income earners, but they have decided to set aside 5,000 naira every month to invest. So what they can do is they can put their 5,000 naira and give it to the investment manager. So that comes to about how much? 15,000 naira. So that investment manager is licensed by the authority. He will go to the market and look for a sizable investment to buy in the name of the portfolio. But inside that portfolio, it will be clear that this thing is owned by Mr. A, Mr. B, Mr. C. There will be a register to reflect that. So they will go and negotiate for either higher interest rate by buying commercial paper or buying treasury bill, or they can also buy bond depending on the capacity or the purchasing capacity of that 15,000 naira. They can also buy equities. For instance, if they decide to buy the stocks of, let's say, Dangote Cement, for instance, they can buy it. It will be owned by the fund, but the underlying owner are those three low-income earners. Anytime that dividend is paid by Dangote, it will go into that pool of fund and it can be shared among those three unit holders. Anytime that Dangote share price increases in price, it will go into the fund, and if you decide that you want to take out your money from the fund, you can call for it. It is permissible. Whenever you see that the value of the pool of fund has gone up, either because number one, the prices have gone up of the investments they made. I give an example of Dangote Cement. Or number two, the company they invested in has paid dividends. Example also is Dangote Cement. You can call for your investment that I have made money at the end of 1 year. It is very likely that your 5,000 naira you put in there becomes 7,000 naira. If you are in need of it, laws permit it, regulation permit it for you to come and request and you take your money. Trust me, if you go and save the 5,000 naira in your savings account, at the end of 1 year, you cannot get up to like that 7,000 naira. What you will get is maybe like 5,300, depending on where interest rate is at that point in time.
Okay, thank you very much.
No, just before you come in, Mr. Ojabelo, and before we let you go, we were talking about investment opportunities in a struggling economy, but we also have to think of the global scale. A lot of things are happening right now, especially with the Donald Trump administration. Every time we're seeing, almost every morning, you're seeing a new order, increased tariffs here and there. But I want you to, from a research and strategy angle, if you could just point us out to some of the opportunities or some of the threats that we have in this administration.
So if we speak to global development like the current, trade war between the US and some selected economies, the way to look at it is as follows. If China cannot really sell into the US, and Canada cannot sell so much into the US because of all of these tariff increases, what does it imply? It implies that they have to look for other markets to sell to. And what it implies is that you have to sell to either existing markets where you normally sell to, other countries or you look for new markets, new countries where you previously were not selling to, and begin to sell to them and let the US be, if you really don't want to go into that trade war. So when that is the case, what it implies is just one thing. Number one, it implies if you are going into your existing market to sell more, you are increasing your supply. When you increase your supply, your negotiating power reduces, your pricing power reduces. When your pricing power reduces, it is positive for those countries that you are selling more to. So in Nigeria here, for instance, this should be something that should play out for us positively. Because the Chinese would have to sell more to us since they cannot really sell so much into the US, and then selling more to us means they are supplying more. Supplying more to us means that they cannot really be increasing their prices, sporadically speaking. So they will just have to manage us and allow, in fact, they possibly will have to beg some markets to take some of their supply from them. So, but if that is not happening, it means that there are some middlemen that are taking advantage of that development. Naturally speaking, it should be positive for us in Nigeria. But talking about the second leg, which is selling into a new market. If you are selling into a new market, it means you have to sell at a favorable and friendly price to them. So which means new market in that case is also positive for them. The only market where it is not positive to is the Chinese market, the Canadian market, and the Mexican market, because that is where all of those goods are originating from. If they are not selling to a new market or selling more in the existing market, it means they have to domesticate it and sell it internally, and they cannot sell at higher prices.
But doesn't that also mean that it could also discourage local production if if there's lots of product coming in from all these countries back into
discouraging local production has to be explained, I think, because we are in a situation where, number one, we don't have the required infrastructure for us to produce all of the things that we need as a country. So which means that whatever we produce locally is inadequate to meet demand. So we are always filling this demand-supply gap with importation. So nothing can be too much and nothing can really be discouraging for local production in that regard. So local production will be going on, but it is until when we reach the stage of having the right infrastructure in place to stand on our own feet, that is when we can be saying that it is dangerous to local production, largely speaking. So, but we still have deficits in terms of demand and supply. So we are filling that gap via that. Look at Presco, for instance. Presco, in that space, we have crude palm oil. Nigeria consumes more crude palm oil than what is produced locally. Both Okomu and Presco are not able to meet local demand. So we are always filling that gap with what comes in from Malaysia and Indonesia. So, and that will be the case in as much as we don't have the capacity and the infrastructure and the number of players that are local players to increase that output for us. So there will still be that opportunity in my mind.
Okay, thank you very much, Mr. Tajudeen. Going to the global analysis effect on Nigerian economy. Now, there is a thought then that during currency devaluation, there will be export promotion and imported goods will be more expensive. Why? Because the currency has been devaluated. Now, capitalizing on the opportunity between the trade war that required the US, the Mexico, the China, don't you see that if China decides to sell more to Nigeria because of the trade war, the goods is also coming in China currency whenever it's devalued. An average Nigerian purchasing power is already affected. Will we be able to buy?
So this is the way to look at it. So whatever we do, number one, we are not completely eliminating importation from our economy. I think that is what is fundamental. Okay? The second thing that is fundamental is pricing. Even if we would need more US dollars, to import, on the back of that, if the pricing is favorable, it is good for the economy. Because what we import could be machineries, what we import could be unfinished goods that will be used locally to increase productivity. When productivity improves locally, naturally speaking, prices should fall. Or at the worst, prices should stabilize. So we cannot completely, eliminate that. The second way to now look at it also is that whatever we do in terms of other trades on that leg, we have some savings that are accruing to us as a country when you consider the oil sector, for instance. Because now that we now have Naira for crude oil sale, that is helping us to reduce the pressure on our FX demand. Number two, we have local refineries working. It also helps us to reduce the pressure on our FX. So we have that sort of little space to accommodate more, assuming that we are seeing more inflow into the economy from like China or Mexico or Canada.
Canada. Thank you very much. Now, when you look at, I think, according to MBS, Nigeria experienced a 16 trillion trade surplus without any quarterly deficit. This happened, we've experienced this maybe over 5 years ago, what we experienced in 2024. What did you think could be the drivers of that surplus? And do we still expect something of that nature in 2025?
So I think the way to look at that development, you are spot on. We have trade surplus. That trade surplus did not materialize because we have higher exports, not at all. It materialized because our import slowed down. Our import reduced significantly. When you are not, getting the required liquidity in the foreign currency market, you will not really have much to import. So you slow down on your production. Let me give you an example. The giant of telecommunication in Nigeria is MTN. MTN did something significantly different last year. What they did was to reduce significantly what we call their capital expenditure, because it required US dollars for them to import some machines, equipment for their business. So they reduced it. That demand that is not materialized is also partly helping our import bill to reduce. That is the reason that we saw that trade
that led to that surplus.
Yeah, that's trade surplus.
Do we expect something?
So this year, I think what most likely will play out this year is possibly the reverse.
How?
And I say the reverse because we have a situation where those in the oil and gas sector are doing a lot more. Number one, in terms of production. Number two, and more importantly, in terms of the investment they are making. If you look at Aradel, for instance, the investment in the Renaissance, business is something.
Capital.
Yeah, that Renaissance deal that they had, that deal is a big one. And what it implies is that once they have invested, they will be ramping up production. And if they increase production, it implies more export for us that can help us to stay in a trade surplus. The second and fundamental thing also to this is what has happened in the refining space. If you look at Dangote refinery, for instance, that business is selling to other countries outside Nigeria. So what it implies is that the more it sells, the more of its likes, the more they also sell, the more for us in terms of our export earnings. And all of those elements will help us to stay like trade surplus for this year as well.
It means that in this year 2025 we are going to, there's likely chance we follow the same path of that.
Very likely, and what may pick up is imports, but it will not be as rapid
to negate
that surplus or benefits we are going to see from export, because that export is being supported by government policy.